Hey guys, welcome back to the channel Let's Make a Mill, where I'm basically using this channel to document my journey towards making $1 million. And I do that by investing into real estate, the stock market, as well as REITs, which are known as real estate income trusts, and other things that may pique my interest. One recent fund I actually purchased into was, or started a small position in, was ARK Invest into their ARK W fund, which is their innovation growth fund. But that'll be a whole other video, a whole other topic to discuss. But I wanted to talk about the real estate income portfolio I have on M1 Finance, which is comprised of 25 holdings now, if I include the new one that I just put in there, but I did not make a purchase on it just yet, which I will go over here in just a moment. But I just want to give you guys a quick update on this portfolio. I haven't done a video on just this I guess portfolio. I keep saying that, in quite some time. So we'll go through the quick basics and then we'll get into it. So right now we have an account value of $22,547 with a gain of $1,335 with a total return of 18%. The market gain is $967 with $368 in dividends. Just in this month of January, I've made $147 in dividends, which was reinvested back into the portfolio. And then this Friday, I actually made a purchase of 2 buys for $500. It was AMT and CCI, and again, it was just for $500. So let's go back. So, as you guys can see, the the slices are all messed up. So back in November, I got a huge bonus from my job, and I basically put the money to work. And I wanted to purchase slices of the pie that were, at least I felt, undervalued at the moment and due to spike any time. Those three slices was triple net lease, the triple net lease sector, the apartment sector, and the strip center sector. So as you can see, strip centers, are doing pretty well. They have huge, it's a huge cash position, of course, relative, but you'll see that it's, the what's in it versus what I want to have in it, and the weighting or the allocation of the target size is different. Same thing goes for triple net lease, and the same thing goes for apartments. So why did I change up these target sizes? Well, recently I learned about market cap weighted indexing, right? And how to kind of like construct your own market cap weighted like ETF or portfolio. So basically, I took all my positions, and I'll put a link down below in the description to kind of what I was reading on Investopedia. And this is exactly how the S&P 500 is constructed, or VNQ is kind of loosely constructed off of. It's constructed off of a market cap weighting. And it basically takes all the companies, looks at their market cap, does some magic, some math in the background, and then that's how you get the percentages for each of the companies. This, for example, AMT I have 59%, CCI I have 41%. I didn't just make up these numbers like I did in the previous portfolio. These come from market caps. So AMT has a market cap between the two of 59%, and CCI has 41%. I forget what the actual market cap values are for each of these companies, but when you add them all up and then kind of do your math, you divide the market cap by the total, and then that's how you'll arrive at your actual target. But sorry for those who are not math aficionados. Let me get back to the portfolio and talking about it. So I did that for each of the sectors because I wanted to. I felt like I was doing something wrong. Like I felt like the overall portfolio was not performing as well. And I was like, and I was using VNQ as my benchmark, and I was like, something's just not right. Like I wonder how ETFs or indexes are constructed. So then, as I did more research, I found out about cap weighting, market cap weighting, indexing, allocation size, things like that. So then I adjusted the whole portfolio. I actually ended up losing some dividends yield when I did this, but I believe that the portfolio will actually perform well in terms of share appreciation over the long term. So I was sitting at like a 3.6, 3.7% dividend yield, and now I'm down to 3%, right? 3.05 or 3.06%. Which, based on a hypothetical $100,000 could be the difference of $600. Instead of getting $3,600 in dividends, I'll get $3,000 in dividends. But the share price appreciation will outweigh the dividend yield, in my opinion, because if I can return 10, 12, 14, 15% in share price appreciation, what is 0.6% in dividend yield? It's not much. So here are my new target sizes for the portfolio. Prior to me making these adjustments, I believe I had triple net lease at uh, the largest of them. I think it was at like 25 or something, or 30. Then I had apartment REITs, and then I had strip centers, and then everything else kind of fell into line. I think industrial was like 9, infrastructure was 9. So you can see the huge difference. But this will be my portfolio target allocations going forward. I still have an expense ratio of 0, and I have 25 holdings. Right, in my last video I had 24 holdings, but I want to introduce you guys to Americold Realty Trust. All right, I don't have any money in Americold yet, because I'm still trying to fix everything, fix the allocation sizes and the weightings. So I have to put more money into the portfolio. But Americold is a cold storage REIT that is used for storing food. So think like meat, potatoes, vegetables, all that other stuff, all the perishables. So that's what Americold does. It provides a space for companies like Whole Foods, Stop and Shop, Star Market, or any of these other places to just basically store food for later delivery to anywhere else. Right now, the market for Americold or for cold storage is actually very fractured. There's not really a whole lot of major players in the space. So I'm thinking, as time goes on, uh, that as consolidation takes place, as mergers take place, or as buyouts take place, Americold will be the one that comes out on top. They have like I said, they have a small market cap, 7.3 billion, dividend yield of 2.35%. And what I'm thinking is, or the way this is going to play out, as companies start to consolidate or buy out or merge, Americold will come out on top. They have very low leverage, which means debt, and they have a very responsible management team. They're trying to keep debt very low, and they're expanding at a very conservative rate. So what that means is, they're not taking on huge amounts of debt so they can grow, but they're growing at a very steady pace while still having a lot of cash on hand. So it's a very responsible move by this company, especially during now, COVID. So I'm very bullish on Americold. I'm happy to add them to the portfolio, and I'm happy to start a position with them. And I feel like in the long term, they will pan out, and it'll be a really great pick. And of course, this is for the 5 to 10 year hold. All right, I don't invest for 3 to 5 months. So that was the new position, and that was pretty much it. I can go down this and kind of show you guys what's been going on. Um, Infrastructure, data center, right? These are the two sectors that were hot during COVID, but now that the vaccines have been found, a lot of investors have been taking their money out, to capture all those gains, and they're putting it towards, other things, things that are going to grow, or new companies, or cruise lines, or airlines, companies that are going to benefit from the vaccine. These were two sectors that were benefiting from the COVID pandemic because more people were staying home. So now that people are going out, malls are actually doing very well. Like SPG, their share prices have actually started to increase from all-time lows. I still don't know if I'm gonna put any money into them. I may put some money into SPG, but again, that's a huge maybe. I mean, they're fantastic. They're a great company. They have a really strong balance sheet. They actually just sold some of their real estate or some of their malls to beef up their balance sheet. To have some extra cash on hand. And they just bought Tubman Malls or something like that. Ticker TCO, or used to be TCO. So SPG just bought them out. Um, so that deal went through. So I think SPG over the long term is going to do very well. But they have so much headwinds ahead of them, especially with not just COVID, but with e-commerce as well. Infrastructure REITs, you have AMT, CCI, fiber, and cell towers. Again, this was COVID. At the height of COVID, people are staying home, streaming service, all that other stuff. And now that people are going out, investors are taking their money out of infrastructure REITs. But I think with 5G being more relevant and more companies leasing cell tower space, both these companies will do very well. CCI is more on the fiber side. As more fiber gets rolled out, again, they'll do very well. So them and data centers, they're not tied to each other, but they're kind of like in the same. I don't know how to explain it, same space almost. So, anyways, we have industrial apartment, triple net lease doing really well. Storage REITs, they're going to always do well, especially now as people are moving away from the big cities into their homes, or people who are moving into cities and they need storage space. They're the companies in the storage REIT sector are going to do very well. And I have PSA and Cube. Those are the only two I have. PSA is one of the bigger players in the space, and I think over the long term they're going to do well. And you see, this is like a small cap outperforming one of the larger players, and I want to do a reverse market cap weighted quote unquote index or ETF, whatever you want to call it, portfolio. Um, but I don't know. Maybe. I don't know. It was a thought that came through my head. If you don't know what a reverse market cap weighted index is, I'll put a link. They actually do one for the S&P 500, and I think they benchmarked the both of them over, I think, like 10 years or so, and they almost the reverse market cap weighted index, S&P 500 index, actually came out on top by like 10 or 15 percentage points higher than the regular S&P 500. But you're paying a higher expense ratio. Anyways, moving on. Single family homes doing really well. Strip centers, of course, doing well since now people are going out. Restaurants are reopening. There's a new normal. Certain amount of space between a certain amount of people. Restaurants have actually gotten smarter about how they're adapting to this pandemic. With shields in between tables. They're using outdoor space. They're creating bubbles, or you know they're just getting smarter or learning to adapt with COVID or the new normal. And again, right now they have some short-term headwinds, COVID, vaccine, um, and several states requiring certain things for spacing, especially for restaurants, and even like movie theaters, they haven't opened up yet, but they're having some short-term pain. But again, I'm looking at the long term, and I know these two companies are going to do very well over the long term. Um, this is a champion in the space. I think it's like 52 years of dividend raises, solid share appreciation. Same thing with the Regency. They're doing very well. So that will do it about it for this portfolio update. If you guys liked what you saw, please let me know down below. If you have any comments, questions, concerns, please let me know. Uh, if you like this video, please subscribe, hit the like or dislike if you didn't like it. Either or is fine for me. And I hope to see you guys in the next video. Thanks for watching.